In today's video, we've got an absolute massive story that we need to cover right now. We've got huge amounts of losses piling up for the banks, unrealized losses that many people aren't even aware of. And we've also got their reserves depleting and depleting quick. So what is causing these massive losses for the banks, and why are their reserves dwindling at such a fast rate? Well, this is exactly what we're going to go over in today's video. And really, there is two things that are causing this. One, there is the car market, which is causing huge losses for the banks. But really, I think the next big catalyst, and I've got some huge stories here to show you, that once all this money that the banks have lent out to the AI industry, and once that goes down, we're going to see this get even worse. So everyone, you know what time it is. Let's get straight into the news, the facts, and the data. Well, okay. First things first is this, everyone. CarMax analyst throws in the towel as road ahead gets murkier. So we are seeing absolutely huge losses for the auto industry. So I'll first cover this, and then I'll show you the shocking charts, which will blow your mind on what's really happening behind the scenes, behind the curtain in the banking system. So CarMax Inc.'s disastrous quarterly numbers prompted at least 5 Wall Street firms to lower their ratings on the stock as the used car retailer faces long-term challenges and uncertainties. And this is not just this company, this is the whole car market at the moment. The company gave preliminary results for the fiscal third quarter that missed analyst estimates by a wide margin, and said it saw a decline in sales of retail units. Now, look at this chart here, everyone. I'll go ahead and move myself so you guys can see the chart here. Or maybe I'll put myself up here. Look at this. The stock is down 62% this year, even as shares of one of its top competitors, Cowan, have risen 47% over the same period. Now, CarMax shares were up 1% on Friday after plunging 24% just yesterday. And look at this chart here. This is declining rapidly, and this is going to lead to big losses for the banks, but there's much more. So investors have mounting concerns about the broader used car ecosystem, especially after the implosion of the subprime lender Tricolor Holdings and parts supplier First Brands Group. And lower income consumers are showing signs of strain as car prices stay high and loan delinquencies rise, which I've been talking about for a while now. Delinquencies for auto loans are hitting record levels. Consumer sentiment across age groups and income in the US have fallen to near record lows as anxieties brought on by the government shutdown strengthen. And that's exactly right. We just got the latest consumer sentiment survey out today, and consumer sentiment just hit another low because all these employees that normally are out there spending the economy, these government employees, well, they've got no money to spend. And this is happening at a time where there's huge amounts of layoffs. And so when we see people not having money to spend, when we see huge amounts of layoffs, that's when we really see a recession kick in. And the reason why we haven't had a severe recession over the past 5 years is because the unemployment rate has stayed steady. But that is all about to shift. So that's just part one of the story, the car market. But part two, we just got a report that SoftBank has taken huge losses from its loans and investments into AI. So look at this, everyone. SoftBank Group logs almost $50 billion in weekly losses as investors sour on AI plays. And I bring up this chart here. Look at this. We saw their stock absolutely get wrecked yesterday, down 8%. The group, which holds a wide range of AI investments across infrastructure, semiconductor, and application companies, saw shares close 6.87% lower, recouping some losses from early in this session. This comes after SoftBank gained nearly 3% in the previous session, having plunged 10% on Wednesday to clock its worst day since April. And it saw almost $50 billion in market cap wiped out this week, and its worst weekly losses since March 2020, when it was down nearly 20%. Now, look at this next part. The pullback reflects growing caution around the AI sector and realization that many OpenAI partnerships are still potential rather than confirmed, with funding prospects uncertainty, told CNBC. Now, OpenAI CEO Sam Altman, He's now, they got caught trying to get a bailout from the banks and from the US government. They're saying, no, look, we don't want a bailout. It's just a backstop. We just want some cheaper credit. But look at this. OpenAI CEO Sam Altman reportedly said that the company has spoken with the US government about potential federal loan guarantees to encourage chip factory construction. His comments come after OpenAI CFO suggested the firm hoped for federal help in securing chip financing. So what do you guys think about this? Should the federal government be funding these private institutions that are going to be taking all of our jobs? Again, now that's part 2, but I'm about to show you these charts which will absolutely blow your mind to show what's really happening in the plumbing of the financial system, what's really happening behind the curtain that the banks do not want the public to know about. So I'll go ahead and pull up this first chart here. So look at this. This is reserve of depository institutions total. Now, this is in billions. So, for example, 1,000 billion is a trillion. We can see here it peaked in November 2021. They had about $4 trillion in reserves. But we can see ever since then, reserves have been depleting and depleting quick. We saw in 2022 and 2023 when there was the banking crisis, they got really low. But now, look at this. Apparently, there's no banking crisis when all these banks were collapsing in 22 and 23, but we've just hit the same amount of reserves. Banks are desperate for cash, and they're desperate quick. And you know why? Because I'll show you this next chart. Look at this. This is unrealized gains, losses on investment securities that's held by the banks. Now we can see here, this little dot here, that's 2008. And look where we are today. Yes, it is better than 2022, but it's still around $400 billion in losses these banks are sitting on. And what are these assets, you may say? Well, what these are is, these are US government bonds and US treasuries. For example, a 10-year US treasury that was issued in the bank brought around 2021 or 2022 might have only had an interest rate of 1 or 2%. But now investors, they can get 3 or 4% on these treasuries and these bonds. So why would they want a bond that is only paying 1 or 2%? Well, it's simple. They don't. So then they sell that. But then they sell it at a lower price. And these are the banks that did this. And so they've got huge losses on their balance sheet. So it's only a matter of time before they have to realize these losses. And then we're going to see a big hit to the banks. Now, this has led to a CEO of Southeast Asia's largest bank warns investors, buckle up, we're in for a volatile ride. And that is definitely true, everyone. We are in for a very volatile ride. So she says here, we're seeing a lot of volatility in the markets, and it could be equities, it could be rates, it could be foreign exchange. She said, adding that she expects volatility to continue. So let's keep reading. She said that investors were particularly worried about the lofty valuations of artificial intelligence stocks, especially the so-called Magnificent Seven. And this is what I've been talking about. These stocks are severely overvalued, and it's only these handful of few stocks which is causing this rally. But then that also means huge risk. If these 7 stocks don't deliver, well, then it's going to bring down the whole market with it. You've got trillions of dollars tied up in 7 stocks, for example, so it's inevitable with some kind of concentration that there will be a worry about, when will this bubble burst? And that's the $1 trillion question. When will it burst? Earlier this week at Global Financial Leaders Investor Summit in Hong Kong, it was likely that they all agreed that there will be a 10 to 20% drawdown over the next 12 to 24 months. And I think it could be even higher than that, specifically for the tech stocks. I think they'll probably see more like a 30% pullback. Like what we see during bull markets, they tend to outperform. But then when we have a bear market, they're the ones that take the bigger losses. Her remarks follow similar warnings by the International Monetary Fund and central bank chiefs Jerome Powell and Andrew Bailey, who have all cautioned about inflated stock prices. Well, again, if they know that the stock market is overvalued, why do they keep lowering interest rates? And why are they stopping their QT, that's quantitative tightening, where they're selling assets and they're going to start buying assets? Well, they know that the system is really actually not as strong as everyone leads on. And also they know that the stock market is not the economy. The stock market could be going up, but that doesn't mean the economy is doing well. So everyone, I know what you're thinking, well, okay, what does all this mean in simple terms? Well, what this means is the banking system is still not sound. It never really recovered from 2008. They simply just covered it up. And now these institutions are so fragile, like I showed you in this chart here, they have barely any reserves. All it takes is for news that one of these institutions are in trouble and the whole house of cards begins to go down. So everyone, you're definitely going to want to prepare. Like I always say, you want to have some cash, pay off debt, have an emergency fund, have some gold, silver as hedges against these institutions going down. And, you know, you see when things like this happen, gold is a non-correlated asset. It tends to outperform. So what do you guys all think about this? Let me know in the chat below. I was just covering this one story today. Well, thanks for watching. You're awesome. I'll see you all in the next video.